My name's Stephen Goakes and I'm the Managing Director of Natgen. I'm here today to talk to you about our forthcoming trust, first one for 2026, which is Natgen Investment Trust PG26. Before I get into the specifics of it, I just want to talk to you about the area that we're talking about in particular. It's a regional area in Queensland, Mackay region, which has Mackay Regional Council as the local authority. We have been looking in Mackay for some time based on interactions with the Mackay Regional Council, which has been very strong, and we've had a lot of really interesting information from them over time. I've been up there on a number of occasions to look around that region, and they are a very surprising and interesting council area with quite a lot of difference in terms of diversity of economy and also the way that the local government is really impacting in a positive sense the growth of the area. One of those areas within Mackay is Paget, which is an industrial area with a lot of large industrial users very close to the airport on the southern side of Mackay. The industrial users there are really high-end users with high value-added industrial uses, including the one that we're looking at today. In terms of how this relates to the Natgen investment philosophy, which you'll have heard me talking about ad nauseum basically, this is a purchase of something that is an industrial asset where we see value add going forwards. This is the first industrial asset we've bought, notwithstanding we've been talking about it for years, and we're very pleased to bring that to the market in 2026. So value add industrial in this case is all about buying an asset with a good lease profile, in this case a lease out to 2031 and options beyond. And the value add part comes from the fact that the replacement of the asset that we've got and we're buying today is going to be much more expensive due to increases in construction costs. And this is something that you'll see as a theme through a number of our investment trusts recently, where actually getting to place the asset is so much more expensive than actually buying it in its current form. And one of the other issues that you'll find when you delve into the trust and when my colleague Lachlan talks to you about the specifics of this is that replacing these buildings is very difficult because of the structure of the building and the size of them. So that is a big issue going forwards. As I said, Lachlan Pappas will talk more about specifics of the asset. I can tell you this, it's a single tenant, long-term leased asset in Paget, in buildings that are difficult to replace anything close to the rate at which they're purchasing them for, and that's really important. So, like all Natgen investment trusts, the income or the return that's generated from an investment trust comes in three forms. Firstly, there's the monthly cash payment of distribution that we make every month to you, and that's the number that you'll see basically in the front of the information memorandum. And that's only one of the three types of return that comes from investing in quality commercial property. Secondly, we've got taxation advantages, and these come from the fact that you get tax deductions for certain non-cash aspects of owning property, and these include the depreciation of the building over time, the amortisation of any borrowing costs, and also any offer costs from the trust. And this is significant in reducing the amount of tax paid through the term of the trust. And the third one, of course, is capital gain, and capital profit over the term of a trust should be linked very closely to what the actual increase in revenue from the trust is over time, because the way you find the value of a commercial asset is basically the revenue or the profit from that asset multiplied by the cap rate relating to those assets. So there's three distinct types of return that come from these type of properties, but only one of them you'll find mentioned in the information memorandum. We're often asked why we don't talk about internal rate of return, and we've made a very specific decision not to do that to date, and principally that relates to the fact that in choosing an internal rate of return number you're actually making an assumption about the future value of the property. Now the fact is that no one can know what the future value of the property is. We can make assumptions or educated guesses, but we can't actually know. So we've taken the decision to be clear about what we can deliver, which is the distribution on a monthly basis, and not actually talk about the actual end value, because that is somewhat variable and somewhat out of our control. So the things that we can do to impact that are make sure that we get the most revenue and most profit from the building on the way through. We look after the asset as best we can so that it's at high value, and that we sell at an appropriate time to make sure that we maximise that value. And that's basically the reason we've never talked about IRR. Of course, we actually do IRR calculations, and we have them within our trust documents, but we don't share them because we can't put hand on heart and say this is exactly what's going to happen. And hence, we take seriously our disclosure obligations to make sure we tell you what we do know and not tell you what we're just imputing. For a number of years now, interest rates have been topical, and this started basically at the beginning of the COVID pandemic and has continued ever since. Through COVID, we saw interest rates go incredibly low, and they stayed there for quite some time. That impacted the value of assets because people were prepared to take less of a risk premium on the interest rate because they were getting a similar premium but on an artificially low rate. At that time, we ended up with a number of assets being really overvalued and people overpaid for them at that time. We were pretty careful not to do that in 2022, where quite unexpectedly interest rates went from that 0.1% up to 4.35% in a little over a year. So it was a very strong gradient of growth in interest rates. That said, when you look in the long term, that interest rate growth was predictable and also probably within the range that you'd expect within the market. But what that has caused cash flow issues for some people in the market, but we've been lucky enough to be careful with our interest rate management strategy, and we've been aware of that. Over the last 12 months or so, we've had a lot of rhetoric about interest rates coming down. And whilst they have come down modestly, there was talk of them coming down much more than they have. I think we always thought that it was unlikely they'd come down very far, notwithstanding the pundits saying that they would. And we've now seen interest rates have peaked, and now they're coming down, and they've probably bottomed out somewhere around the level that they are now, maybe one more interest rate cut. That's certainly what the market is telling us. So with that, how does that impact what we do? For all the trusts that we've put into the market in the last 3 or 4 years, we've been watching interest rates and picking a time when we hedge them, in other words, fix the rate at a place that's suitable for the trust. And pretty much in every case of 2024 and 2025 investment trusts, we've waited for the 3-year rate to come down below the forecast that we've put in our information memoranda and immediately fixed it at that point. And that's given us, and of course our unit holders, certainty of our interest costs over that 3-year period. And that's very valuable when you're managing the other variable aspects of these trusts. Having one major cost which is at least fixed is pretty helpful to us. The only trusts that we didn't do that for are the ones that are coming up for basically sale in the next 12 to 18 months, and it would have been inappropriate to fix rates for longer than the term of the trust. So what are we doing now? We keep looking at interest rates, we keep making judgment calls about where we think they're going to go, but they're probably not going to go far in either direction at this stage, as we understand it. Economists are making all sorts of predictions one way or the other, and we're just taking a line pretty much up the middle. And that's, interestingly, exactly what the money markets are doing. So if you look at the pundits, if you look at the Reserve Bank, and you look at the money markets, that's the best we're ever going to do in making a judgment call of what's going to happen to interest rates in the future. And I think a very wise group of commentators often call this a crystal ball gazing pursuit, because it's literally that. But what you can be assured in a Natgen trust is we're watching it and we're reacting to interest rate movements within our mandate and as best we can. I'm often asked how the Natgen management style varies from that of our peers. Now, I don't know exactly how our peers manage their assets, but I can tell you how we manage ours, or yours, and that is by being careful with every single payment and every cent that we spend. Cost control is really important, but also CapEx management is really important so that we're actually spending on the asset to make sure its value is maintained over time. You know, you wouldn't not paint your house for 10 years and let the paint start peeling off. And it's basically the same with any real property asset. And in the commercial space, we have to make sure that the mechanical services are looked after, literally the paint's looked after, the roofing is sound. All those sort of simple things, we make sure we do those carefully. And we do most of it, by the way, in-house. And that means that we can have very strict control over what's going on. We've found over time that when we use outsourced management groups who are very capable and professional people, it's easy to lose control of the things. And really, it's kind of the old adage, you know, watch the pennies and the pounds take care of themselves. Well, that's very much true in property management as well. And the one thing that I can promise you in all of this is we certainly manage these things as if they're ours. And you can be assured that we make sure that every single piece of what we do in a management sense is part of a broader puzzle and a broader plan of how to manage the asset, specifically looking towards that point in the future where we're going to sell it. So we want to maximize revenue and maximize profitability at that point where it goes to market, so that the cap rate which is going to be exerted on that revenue stream or that income stream is exerted on the biggest possible number we can get. And that means taking literally a 5-year view to make sure that the leases are in the best state, the property's in the best state, and it's the most presentable it can possibly be at time of sale. Natgen Investment Trust PG26 comes at the start of the 2026 year and is the first Natgen Trust for the year. That's coming off the back of a really big year for Natgen. So our investment trusts in 2025, we had 2 investment trusts, one which was a shopping centre investment anchored by a Coles supermarket in Cooma in New South Wales, which we took in early in 2025 and we're very happy with. And second was an office building in suburban Brisbane in Cannon Hill, relating to that sort of suburban office market. And again, that related to our investment philosophy of looking for assets within defined criteria. Also in 2025, we've taken on 3 new development trusts as well, which will come to fruition in the coming years. But probably the biggest news from Natgen for 2025 is that we actually finished 5 developments that had been put in place over the last couple of years. These included 2 large-scale self-storage facilities, between them worth about $70 million, and then also 3 office warehouse complexes in southeast Queensland, delivering a total of 60 strata title units to the market. And basically 45 of those have now been sold, and then 15 of the last one of those are now ready for sale. So that's a significant movement within our development business over time, and that will continue. So within our investment trusts, of which PG26 is the first of 2026, we're continuing to look for those types of assets that we have been looking for before, and they are non-CBD office buildings, they are regional convenience retail, value-added industrial, which of course PG26 is one of those. We've also got our specialist assets where we're looking for things like medical centres and various other specialty areas. And then development, which of course is also a significant part of our business. So you should see during 2026 more of those areas being dealt with within our trust offerings, including in investment trusts and also in our development trusts.